Today we're going to talk about a conceptual framework for accounting cash versus accrual, GAAP versus international accounting standards, debits, credits, and the like. First question we have to ask is why are businesses formed? Clearly it's to pursue a business or investment strategy, to maximize profits from that business, of course. But the key thing is that we've got to locate investors and then make the investment. And once we've done that, we need to ensure an optimal financing mix, whether that's debt, equity, or a combination of the two. And then obviously at the end, we want to return cash to the investors. So here's a very simple way to look at it. Investors, company invests, we come up with the optimal financing mix, and then we return cash to the investors. So the question is, how do we measure our success? Let's think about the lemonade stand. The importance of accounting is succinctly stated. I love this. One cannot understand any business without the proverbial lemonade stand, beyond the proverbial lemonade stand without understanding accounting. What is accounting? It's a way for us to track our money and our revenue, what comes in and what goes out. So take a look at the stand. The stand itself is a long-term capital asset. The working capital inventory is the lemonade on the top and the cups, which are going to be sold. On the asset side, take a look over here and you'll see that we've got cash, receivables from operations. Well, there's no receivables, obviously, because you've already collected it. On the liability side over here, what do we have? We have mom and dad who loaned the money to finance the operation. And then on the equity side, we have us who own the remaining income after we make payments to our parents. And again, accounting keeps track of the money and assets, and these things are obviously very important. The first key objective, though, I need to underscore is to provide understandable and useful information to our stakeholders for use in making business and economic decisions. That's why this course is so important to you, the corporate lawyer. Our stakeholders are simply management, directors, owners, investors, financial analysts and investment advisors, creditors, lenders, regulatory authorities, Securities Exchange Commission in the United States, the Internal Revenue Service in the United States, Public Utilities Commission that regulates our gas and electric utilities, the Federal Trade Commission, and then of course vendors, suppliers, they're stakeholders in our business, customers, employees, labor unions, legislators, teachers and students, and then everybody else. The second key objective is to provide accurate and meaningful information. What we're trying to do is disclose financial performance during when I say a period certain, that would be an accounting period of a month, a quarter, 3 months, or a year, calendar or fiscal. And it focuses on income and expenses on what's called an accrual basis, which we'll talk about in a couple of minutes. What it does is accounting discloses available economic resources. Now what's that? We find that on our balance sheet. Working capital, the assets that generate or build our products or house our consultants. The claims on those resources, and that's simply stated who's got a claim on them. For example, lenders and shareholders. And how about our liabilities at a given point in time? We also want to make sure that that accurate, meaningful information permits the assessment of the timing, amounts, and uncertainty of our future cash flows. And that gets to our analysts in assessing the enterprise's value. Assumptions are pretty straightforward. Concept, importance of separate entity. What does that mean? The enterprise and its owners are separate legal entities. You'll cover that in Professor Scotton's, I think it's governance class. By separating the owners and the enterprise, it means that the owners have limited liability. Again, that's going to be a discussion for your governance class. Going concern is another issue. We want to make sure that this company really is going to be there, because then if it's not, how do we care about historical cost? Historical cost, by the way, is not an issue when you're valuing the company at net realizable value, which is what you do when the company is not a going concern. Accounting period, I mentioned that in the last slide. Accounting information must be provided on a periodic and timely basis. And then, of course, we must have a consistent unit of measure within the financial statements. So for U.S. corporation, it's going to be the U.S. dollar. For Unilever in the UK, it's going to be pound sterling. And for companies headquartered in Western Europe, in the Eurozone, it's going to be the euro. So let's look at the desired data characteristics. The most important, the data has to be relevant. It has to be material. And it has to be reliable. Secondary characteristics are comparability from one period to the next and consistency from one period to the next. In other words, we're doing it the same as we did it last year, this year, and the year after, so that we can compare back and forth. And then most importantly, it needs to be substance over form. You might say, why not accept our numbers as is? Well, as I like to say, the best way to separate a fool from his money is talking him into accept it as is. The reason we don't is that there are myriad accounting rules and conventions. There's that critical issue of consistently applied. And then, oh, by the way, GAAP, International Accounting Standards, IFRS, International Financial Reporting Standards, there's interpretation of those things. Wait a minute. Materiality? If you've got $10 billion in revenue, is a $100 million expense relevant? Material? Probably not. Estimates, allocations. With the accrual system, we estimate what we're going to owe. We make allocations of our overhead, selling, general, and administrative expense to our various product lines or subsidiaries or divisions. There's the issue of recognition of revenue. Seems pretty straightforward, but we'll talk about that during this course. And lastly, we're thinking about historical cost. Historical cost less accumulated depreciation. The depreciation represents the using up of that productive resources capability. Their natures, limitations of accounting, which are extremely important to be aware of. Management information systems, enterprise reporting packages, and other sources of financial transaction data. But here are some accounting concepts and issues we need to keep in the back of our minds. The balance sheet is a snapshot in time. The income statement is a snapshot in time, the change of time A to time B. The US dollar, euro, yen, single unit of measurement for consistent comparison. Natures, limitations of accounting. Where do we get the transaction data? Management information systems, electronic or enterprise reporting packages, that would be SAP, for example. There's some critical accounting concepts and issues. The accounting records record a snapshot in time, as in the balance sheet. Plus, there's the change from time A to time B. Income statement, cash flow statement. What about the single unit of measurement for consistent comparison? US dollar, the euro, the yen, pound sterling. And lastly, does an audit necessarily ensure reliability? Some more thoughts. Remember that the balance sheet is a representation of what's there. It's not the real stuff. It's not the real assets. It's just records, paper records, digital records about the assets, the liabilities, the income statement, financial transactions. And the key is we need to make sure it's relevant. Limitations. It hasn't been consistently applied. Remember I said accrual estimates versus cash. Virtually all corporations use accrual accounting. And the concept there is you just want to match your revenues with the expenses incurred to generate those revenues in the same period to understand the profitability of your operation. Third one here is periodicity. In other words, are we using the same accounting period for comparison purposes year over year, quarter over quarter, so forth and so on. And then there's the other question we have to ask ourselves. Are reported earnings true earnings, end quote? I'll let you think about that. Well, as you may know, in the United States, we've been talking about moving from GAAP, generally accepted accounting principles, to international accounting standards, International Financial Reporting Standards, IFRS, for some time. I'm not sure today what the convergence timetable is. 2, 3, 4 years ago, 5 years ago, it looked like it was going to be 2 years ago. But now there's some question as to whether or not it will actually happen. So it's important from your perspective as an international lawyer, working with international companies, to understand the differences between GAAP and IAS. More importantly, to understand what GAAP is. There's substantive differences between the two. Inventory valuation, which we will talk about shortly, as in last in, first out, as opposed to first in, first out. You can't do that under international accounting standards. There are issues relating to construction revenue recognition, extraordinary items, and operating leases. We have operating leases in the United States, but they're capitalized under IAS.